Hey traders, welcome to Charts and Coffee. Happy Tuesday, everybody. We've got a couple events coming up this morning to keep an eye on. Number one, and probably the most important event for the morning, is going to be the JOLTS release. This is the job openings number. And yes, it's on a week that we're going to hear from Jerome Powell on Friday, and we're going to get non-farm payroll on Friday as well. But on the way to that day, JOLTS is going to be an interesting little pit stop in unemployment versus employmentville. Ultimately, this is considered basically a leading indicator, right? How many job openings are there that we would imagine that would map to employment? So it is a different metric than non-farm. And it's probably, when I look at employment impact on, well, the equity markets, and also in terms of what the Federal Reserve is most likely to do, I put JOLTS probably second after non-farm, and actually before initial claims. So we'll definitely keep an eye on this one. That's 10 a.m. this morning. Now, when I have a 10 a.m. hot zone like this, when there is a data dump 30 minutes after the bell, one of the things that I'll try to keep in mind if I'm day trading is try to get a day trade entry before, say, 9:45, but not immediately in front of 10 a.m. So I like to leave a little bit of a follow-through window between the entry and the data release. And then after the data release, and I do mean sometimes moments after the data release, if there's an opportunity, if the data is the reason price action will close the distance to a support or resistance level, great. I can use JOLTS as a catalyst, as a hot zone to trigger maybe the morning's round of, it could be day trades, it could be swing trades as well. Swings will be difficult though. Overnight exposure going into Friday could be difficult because tomorrow we've got the deadline, the tariff deadline. What are they calling that? There's a name for it. But anyways, we have the tariff deadline tomorrow. And then on Friday, and actually a lot of folks say, Rag, you seem to be very much sort of dismissing the tariff conversation. Yes, and here's why. We've talked a lot about this in the room and in the videos, and I'll touch on it again today. We all know buy the rumor, sell the news, right? We all know buy the rumor, sell the news. What does that mean? Well, when we hear that Apple is going to have a product release, we always know months, if not at least weeks in advance. And what typically happens to the stock? It rallies in anticipation of, the iPhone being able to levitate, whatever it may be. But we rally in anticipation of what we expect to be positive news. Well, there is such a thing as sell the rumor, buy the news. A lot of times the end result is something called a relief rally. So when we know there's news coming of maybe the negative sort, the way these reciprocal tariffs have been going, we sell in anticipation of fear, of uncertainty, of just something we think could be a negative catalyst to stock prices. And then when the thing isn't as bad, right, we get a relief rally, just like we rally Apple stock, and then, Apple's going to put the 17th camera on the back of the thing. We go, wow, okay, another camera, sell, right? Buy the rumor, sell the news, sell the rumor, buy the news. And the ultimate, and ultimately it's this relief rally conversation that I'm thinking about for Wednesday. I'm not going to continue to short at lower lows. If you want to short into that news on Wednesday, do so from higher highs, like yesterday. Right, we are still in a bearish chop. And if you want to kind of trade outside of this, shorten the time frame, right? So that way you can be flat in front of certain types of events or certain days, or look out into the, what I would say is look out into the weekly time frame, maybe even the daily, but definitely the weekly. All right, let's see I guess we lost sound in one of our rooms. Okay. Give me 1 second here. All right, I'm not sure if it's still working, but sorry, gang. If I can't get it to work, I'll just cut it. Not a big deal. And I think we're back. All right. So if I look at the short-term time frame, yeah, I'm broadcasting on. Thank you, I appreciate that, Danny. I'm broadcasting in the Simpler Central room, which is a completely different room, and then I'm also on YouTube for Simpler Trading, and also my YouTube for Raghee Horner. All right, I think we're good. All right, if not, I'm not gonna sweat it. All right, so moving on to Wednesday. Okay, if that reciprocal tariff conversation isn't as negative as what has been discounted. Gang, I'm not talking geopolitics. I'm certainly not talking politics. If the news isn't as bad, just put it right there. Thanks, Ma. If the news isn't as bad, then we'll likely get a relief rally. And what's really interesting is we have yet to take out the low, as you can see here, from March 13. We have yet to take out the 5,500 level on the S&P. So these are all things to keep in mind as we cruise on into hearing from Jerome, the man himself, on Friday. And I was actually just reading something, and if you do follow me on Twitter, I think it reposted. Oh, did it not? So it's a really cool little blurb from Druckenmiller. Here it is, right? I love this. If you get a chance to check it out, I'm at Raghee Horner on Twitter, X, whatever it's called, and I made a post, a tweet, and it's about Druckenmiller. The other thing he taught me is earnings don't move the overall market. I can't tell you how many people still think earnings matter to overall market trends. They do not, right? It's the Federal Reserve Board. This is why we look at metrics like non-farm payroll. This is why we look at metrics like the PCE in order to understand what the Federal Reserve is going to do next. This is why I look at Fed fund futures. I look at the data, what it's suggesting is the most likely scenario, which is extremely accurate. Yes, it adjusts, but it's going to adjust after every high impact data that falls into the category of the Federal Reserve's dual mandate, which is get to the inflation target without wrecking the jobs picture. So it's inflation and it's employment. And right now, yeah, gang, it's as you can see here, 67% expectation that there will be a rate cut quarter point in June. And then you can see here almost 10%. Tack that on to the 67%, because that is the 9% chance that not only have we cut rates in May, not likely at all, and then we cut rates in June again. So it's the difference between what television likes to do, which is speculate on this could happen. Yeah, I could become the Federal Reserve chair too. Doesn't mean it's going to happen. So they speculate, well, this could happen. I literally turned on, and I don't know what I was thinking. I turned on the television yesterday, which my mom called it the dumb box when I was growing up. And I turned on financial media, the one most of us watch. It's the most popular one. And I watched this dude wax poetic about what he thinks about the Federal Reserve. My gosh, I guess they've got to fill the hours of the day somehow. I don't care what you think, dude. What is the data, right? What is the data? And equally, I even try not to say think about what do I think. It's what does the data say? And right now the data says we're going to get a rate cut. So literally, this was a 10 or 15-minute discussion about his feelings and his thinking. And I said, wow, I guess the reason this isn't a data-driven discussion is it would be 45 seconds. Fed fund futures show that at the June 18 meeting, we're going to cut quarter point. And then Fed fund futures show that if we get that quarter point in June, there's another approximately 52% that will get a second quarter point cut in July. Ta-da! That would have been it. That's the hilarious part of it all. So why do we care about non-farm? It could either ratchet up or lower expectations. Now, how would we ratchet up expectations for a cut in June or July if the non-farm payroll number is lower? So disappointing employment data, either higher unemployment, lower employment, lower job openings, anything that suggests the employment picture isn't as rosy, puts a little bit of pressure on the Federal Reserve to cut. So this is where bad news is bullish, right? And those are things to to keep in mind. All right. So there we have what's going on with non-farm, hearing from Jerome. And what is far more important? Are tariffs important? Sure. But just like everything else, it won't be as shocking. We'll move on from this. What's the most important thing? Certainly isn't earnings. Earnings is a spectacle that's as needless as it is absolutely useless from a macroeconomic perspective. Everything, gang, boils down to liquidity. And this post that I reposted, so this is I think straight from Stan Druckenmiller, who's arguably the greatest trader in the history of ever. Yeah, check it out, right? It's not earnings. People ask, Rob, do you look at price to earnings ratios? And not really. And I've been investing for over 30 years. Don't really care what the fundamentals are. And I'm not here to tell you that if you're looking at that, it's a bad thing. What I am here to say is we just look at liquidity and we look at trends. And what we do and what we don't know about a stock, whether we're investing or trading, is built into price. It's built into volume. It's built into volatility. So I'm never going to look at any kind of ETF, stock, futures contract and I think I know everything that's affecting the psychology of the movement. We simply don't, right? But price is reflecting what all those different market participants are thinking. And when we have events like non-farm or Jerome Powell, then we can all agree, okay, that event is what is directing that next move. All right, there's a question earlier. It's a little bit inside baseball pertaining to one of my indicators called the V-score, but this will apply. My answer, hey there, PH. My answer will apply to anything where you're using an anchored volume tool. It could be volume profile. It could be an anchored volume weighted average price. And of course, my tool called the V-score. All right. So the question is, on a daily chart or higher, is it wise to anchor set the end of day V-score? Again, substitute volume profile, substitute anchored VWAP. In terms of this anchor, is it wise to set it to the beginning of the year or go back further? PH, by the middle of the first month of the year, so this would have been mid-January, I will go ahead and anchor a daily time frame V-score to the first trading day of the year, which happened to be January 2. Now, if I wanted to anchor an anchored volume weighted anchored price, and you can do that, it's built into TradingView, which is pretty cool. Not a rolling one, by the way, not a rolling one, not one where you just turn on a VWAP. I'm talking about an anchored VWAP. And then I go to the first trading day of the year. You can see here, I click on that and boom, there is the anchored volume weighted average price for, as you can see here, for the year. The other thing that I have along the right edge is the volume profile. And this would fall in that same category. I'll look at that roughly from the first trading day of the year. And while there are other anchors, there are going to be numerous reasons where you could take an anchored volume weighted average price and put it on a chart. And if you're curious, yeah, that's all this is. All I'm looking at is the volume weighted average price, and I'm putting it on a specific day rather than it just kind of rolling along based on a set number of periods. So PH, that's the answer there for the daily. And then for the weekly, it's a little bit different. Because for the weekly, it's not enough data to just look at, say, the first quarter. So I anchored a little bit different, usually based on events. All right. And by the way, speaking of weekly, today in the Sector Secrets Mastery, I'm going to dive into our longer term position portfolio. And one of the things a lot of members have been asking me, we've been doing this session since mid-2022. So a lot of years now. And this is where I alert out longer term position trades that I'm interested in taking. And we've had a total of 19 of these in that relatively short period of time, 17 of which have triggered. So I send out an alert. This is the price at which I want to buy shares and whatever that symbol is. And 17 of those 19 reach their triggers. By the way, 4 of those 17 did not do what I wanted them to do, and we cut them. And that's, again, probably a pretty dramatic difference between what, say, an investor would do, dollar cost average, hold on to it forever, terrible idea, versus looking at a position on a longer term time frame with a 6-month minimum to multiple year time horizon and say, hey, within a set period of time, and maybe a set percentage. If I don't see a return on this money being locked up for this particular symbol, I'm going to get rid of it, right? Or if it starts to lose money within a certain amount of time. So there are reasons to close out longer term positions, even if it's something that you were thinking you would hold for years. Because remember, I don't know about you, but I'm not Buffett and I don't have billions of dollars sitting on the sidelines. So I don't know where to put it. If I've got money at work, I want to get the most out of it while it's working and still have some cash reserve so that when something, some opportunity does present itself, like the opportunities we're seeing now in these 10 and 20% pullbacks, that I can again put some capital to work. And the challenge with investing is oftentimes people take a different mindset. I'll dollar cost average. I'll add to the position. I own it forever. I don't know about you, but I'd actually like to touch my money. Forever is a terrible habit. There should be a date at which we know we have to start shifting. Retirement. We know retirement is a due date. At some point, we're within a certain number of years of needing the money. We should adjust the way we manage open positions. And to me, that's more trading. So I'm not here giving investment advice. That's not my thing at all. I don't care if I buy something and hold it for 20 years. If I've got an exit plan, if I had an entry plan and I have risk management, that's a trade. Can you put on a 20-year trade? You can. Trading isn't a short-term thing. It's different sets of rules around the activity. So we'll be doing that. And the reason I have Altria here is 4 positions that we put on this quarter. 2 of them we put on in January when the news certainly wasn't favorable to buying, but the setup was there. One of the many reasons I don't use fundamentals. I don't care about headlines and news. I'm looking at the way in which price action is sitting in a certain half of the chart and patterns and different levels. So we bought Coke at $61. We bought Altria at $51. And these are the kind of positions that I want to hold for months, if not potentially years. And right now is a really cool opportunity for those kinds of entries, because 10 and 20% pullbacks, and I think I tweeted this as well. I can't remember the last time that I looked at what I call a sanity check setup. Where are we on the weekly time frame? Are we above certain key levels? So I'm not wandering into a stock that's on its way heading lower for a prolonged period of time, because that can happen too. Just because something's cheap doesn't make it valuable, right? That's something we need to always differentiate. But when I see 10 and 20% pullbacks and I make sure that I met the criteria of what would be a valuable name to buy on sale, I can hardly ever remember when I've ever said, I wish I didn't buy that 10 or 20% pullback with a longer time horizon. I have said many of times I should have bought the 10 to 20% pullback when it happened, because they don't happen often. And there is a natural drift to the market. And it's not manipulation, right? There's a natural drift. The markets, the indices, the Russell, the Dow, the NASDAQ, the S&P, you'll know there's rebalancing. There's reconstitution. That's a purposeful design. Now, I'm not saying in any way it's wrong or right. I'm just saying this is what is. And traders would do themselves a lot of good at just saying, this is what it is, and I'll respond to it. So whenever there's a rebalance or a reconstitution, what they're typically doing is what? I think most of you know here. They're getting rid of underperforming stocks. They're putting in performing stocks, or they're increasing the weighting of good performing stocks. The goal is to create a high performance index, right? So it's designed to try to do that. Do they always succeed? Of course not. They just increased the weighting of NVIDIA and the XLK, right? That was probably peak NVIDIA when XLK, the ETF, decided to do that. However, it is designed to be rebalanced, reconstitutions. And then also there's a natural drift to the upside of the stock market. So as I like to remind folks and myself, bulls make money. Bears like to be on television. I know, a little harsh, Rag, but yeah, completely true. I find it hilarious that perma bears can even show their face. I mean, seriously, this is the stock market since 2012. Go back if you want to have a fun exercise on a weekend. Look at every all-time high and then find a 10 to 20% pullback. And you tell me whether or not there's a natural drift. So yeah, gang, when I look at something like this, It's akin to ringing the dinner bell. And I hope that everyone's looking at those names that are valuable and on sale. All right, gang. I'll see you tomorrow, same time, same station. Be good to each other.